crowdfunding the rest of the fund, right now I don't see why we would do it, because we don't need to. But there might be a time where we're actually...
Some of us do need to.
So Dave, you would consider it, yeah?
I
mean, you've got a huge cult of personality around you.
What?
You've got a huge cult of personality around you. You could have, with your Twitter following and your conferences, you could easily have 10,000 people put $1,000 each, I believe.
I actually think what Dave and people like Dave could do is if he's made, over 500 investments, you could have each one of them throw in $1,000 or a few $1,000 kind of back. So the graduating class, as it goes and raises money, takes a little bit of money and throws it back in the next
I think that would be the definition of round tripping. And I think AOL got in trouble for that back in the day.
Probably there's a 5-year to 10-year delay on that round trip, so I think that's fine.
It's kind of interesting to think about it because the incubators and accelerators, what they've done is they've brought the school model to the investing scene. And so if you have a school model and concept of classes and graduates, then why not have a concept of alumni donations and giving and grants and scholarships?
So you're saying I should ask David Sachs today to put $250,000 into the companies?
I think he owes it. Sorry, Dave.
I
just sold you out.
So I don't think I'm breaking any SEC violation by saying we actually had a company exit in our first fund, and at the time we were still raising that fund, and the founders of that company put money back into the same fund that they had actually been invested out of.
Quite incestuous.
What?
It's quite incestuous.
I think
no, actually that's a strong statement of positive.
It's awesome. I mean, look at Y Combinator, right? They have former alumni like Sam Altman and Harj Tagger and Gary Tan who are running funds that then invest in YC companies, and pretty much only in YC companies. So there's a lot of precedent for this. I'm just saying institutionalize and formalize.
I think, Jeff's point before, obviously if you're raising larger vehicles, you probably eventually want to be raising from institutional investors because they write big checks. At the same time, a lot of the work that gets done in terms of mentorship, occasionally in forms of selection, building a community is done by people who might write much smaller checks. And so for some funds, which will remain unnamed, we didn't have the opportunity to raise from larger checks, and we had to go to larger community-driven results, but we wouldn't stop doing that just because we're able to get larger checks in the future. The value of a lot of small investors is possibly greater than institutional investors in terms of their ability to participate. And there's a blog post I wrote about changes in venture capital where I talked about YC being almost a guild of geeks and other early stage incubation or maybe early stage seed funds moving toward that model where it was community driven, at least in a lot of the things that happen, whether that's selection or mentorship. And I think that's one of the biggest changes that's happening in the Valley that's kind of often overlooked because people focus a lot on size of fund, but actually the structure of the teams that are doing venture capital investments and the types of non-capital based resources and activities that are going on is dramatically changing and dramatically different.
By the way, this seems like a lot of inside baseball to a lot of you, like VCs raising their funds, but the interesting lesson here is that venture investors spend just as much time fundraising as you do. So more. So don't think that it's just your pain. I think the venture community, what they do is they go and they deal with it, one time. It takes them 12 months to raise $100 million, and then it's a lot of misery and a lot of work and a lot of pain. They come back and distribute that misery out in small chunks to each of you by making you jump for your chunk.
Payback. I talked to no less than 150 people in 2011, probably 200.
To raise money. When you're investing in a company today, and let's say in their angel round they raise $250,000 to $1 million, what is your instruction to them, or do you even give them instruction of, hey, by the time you've deployed this capital, this is what you need to have shown? Or is that just something that's up to the startup to do? And what would you advise them, thinking here for a minute out loud, what would you advise them today if you were, raised an angel round at this event? 3, 6, 9 months, let's put it out 9 months, 9, 12 months from now, what will you need to have shown in order to get that next investment?
Well, I think it obviously varies from company to company. I try not to get involved in companies on that level unless, we're on a board level or we have advisory roles. But, I think obviously get to some kind of traction and revenue, get people to believe in your product and get customers. I mean, that's really what it comes down to. You know, if you actually have a real business where people are paying you or you've got eyeballs, then, you know, that's going to be more attractive down the road.
What do you guys think of, you know, in terms of what is it in 2013 and going into 2014 startups are going to have to show? Because we keep talking about the
So
bench.
companies that have raised a seed round of
Seed
$500,000
round.
to $1 million.
Yeah, if you've raised, you know, let's say under $1.5 million and you anticipate it runs out a year from now or so.
I would say on a revenue basis, if that's your measurement, probably you want to show $500,000 to $1 million in annualized revenue or better.
Run rate.
Growth prospects at, you know, 100% or better per year if you can. That at least puts you in the conversation.
It does absolutely vary from company to company. I would say it's that you have to show traction. Traction is quantitative evidence of customer demand. It varies from sector to sector, but if you're a consumer, it's escape velocity, and we'll know when we see it. If it's enterprise or SaaS, you know, get your first few customers, and if it's hardware, get your product at the door and have a nice Kickstarter, right? So it just
might
varies.
just be a prototype, you know.
And if you have no revenue model, then it's a much higher bar.
Absolutely.
And you're looking at, I don't know, at probably, depending on the business again, millions of active users. Certainly not less than hundreds of thousands of active users.
So the change we've seen over the past couple of years is seed funds investing essentially, you know, we do $500,000 as a basic sort of bite size. So we always participate into something which is 1.2 to 1.5 to 2. And, you know, 18 to 24 months is basically the runway it takes to get your product to market, figure out your PR, marketing, user acquisition, churn, and then figure out what are the key metrics that you need to show some growth on. And
I'd
so
love to say 6 to 18 months, not 18 to 24.
maybe in your model, but in ours, we assume 18 to 24.
Right, but if you tell them 18 to 24, then they'll take 24 to 36. So if you tell them 6 to 18.
But by the way, a lot of this stuff is confusing because the entire market has shifted so much. In 2003, 10 years ago, Series A venture capital in Sand Hill Road would invest in teams with ideas. That didn't happen anymore in 2007, 2009. People like Jeff and I were the ones who were investing in ideas. That was seed stage capital. Today, only the accelerators invest in ideas.
Well,
and so,
some of us don't invest in ideas. We require functional prototypes.
okay, so he doesn't even invest in ideas anymore. So if you have an idea, you can go home now. But you need to basically...
I've got lots of ideas.
It's
but
the cost of building a company has collapsed so much that you basically need to have built something before you can talk to Dave, and you probably need to have traction before you can talk to Jeff or Cyan. And that's just the nature of the market. Now, there's always exceptions.
Right.
But
which is a good thing.
yes.
So if you're a person in the audience who says, I have a great idea, coming up
Well,
and
fucking build
stage
it.
diving and shaking hands with you guys and saying,
Is
oh,
useless.
I have a great idea. You're just going to glaze over and say,
Go build something.
What, go build something.
Go build something. Yeah.
Well, I think it depends on their background. I mean, so like if Elon Musk came up to me and said, I have a great idea, I would get my checkbook out and write him a check, right? So I think it really depends on whether they're a first or second time entrepreneur, what kind of track record they have, because I do invest in people and ideas, but not someone who's green, who's just starting out, that, you know, I would not write a check there.
But I see a lot of second-time entrepreneurs who are unprepared for how brutal the competition is
Yeah.
and how much execution is going on out there. I see a lot of second-time entrepreneurs who come out, raise money based on their reputation or try to raise money based on their reputation. Then they assemble a team of 15 people and they kind of all get together and start whiteboarding stuff. And meanwhile, there are little fast commando teams on, 2-3 people inside 500 startups or Y Combinator or Techstars or AngelPad that are just crushing it. They're just building product. There's so much leverage in the system thanks to the tools in the cloud and the services that are available and how little capital it takes that you can just execute a lot. It's faster to execute than it is to talk about executing.
I mean, it's not because we're trying to be assholes or anything. I mean, you might have a great idea, but like the bar has been raised on, okay, take that great idea, build at least a functional prototype, get a few users, because it doesn't cost that much time or money to do that. And furthermore, there's significant risk reduction in you getting a functional prototype together. So, like, you shouldn't need me to fund your idea. You should be able to build the functional prototype idea.
Yeah, it's becoming like media in software at least. So in software, it used to be you could raise money to write for software, but now it's like a book. You unless you're famous, to Cyan's point, you don't go to the publisher and say, give me an advance to write a book. You just say, here's my book, what do you think? Right? So
Or
just
here's my
write-
first chapter.
Yeah, right. So sit down and write the book. Unless it's hardware enterprise, which are obviously different things.
And if it's hardware, maybe you can even get Kickstarter or pre-funded.
Yep, and now there's Lemnos Labs and Accelerator and others that let you do some quick prototyping, tech shop.
But the point is that you have multiple ways to get your ID funded without going to traditional sort of angels or VCs, and that's what we expect. That's what the bar is.
Okay, this is the part where you guys are incredibly honest and tell us some inside information. Tell us about the first meeting with the most successful investment you ever made. The first meeting, where it occurred,
This is a pretty
who it was
soft
in,
question.
and the highest return ever. Well, it's picking favorites, right? But I'm giving you a qualifier that it's not your favorite investment. It's the one that had the biggest return, even if it's a return on paper right now.
Okay.
Who wants to go first?
So return potential or return?
Well, wherever it's marked out currently. So if you're an investor in Dropbox and it hasn't exited and it's worth $10 billion, you could count that. You don't have to count an actual exit, but if it's marked to market, highest.
Yeah, my best investment was actually my first one. I should have quit right there. And
It's been all downhill ever since.
when I knew nothing, I did a lot better. It was Twitter, and it was because I had a friend who was obsessively using it, Cool Beer Tiger. Thank you, Cool Beer. And he just told me about it, and I tried it out. I was like, oh, it's kind of interesting. Evan Williams was already well known at the time. I forget how, but I tracked him down through some email introduction. I kind of finagled my way into a meeting. I went in there at the time. I was kind of reading.
Where
up
was
on
the
all-
meeting?
It was at their office in South Park. And at the time, I'd been reading up on viral marketing and trying a little bit of stuff. So I got in there and I kind of pitched this whole thing about viral coefficients, and I was a viral expert, and I whiteboarded the whole thing. And Evan looked at it and he said, "That sounds great. That sounds really useful and knowledgeable. We're not going to do any of that." And that was correct of him. He grew the network organically. But then I basically asked, can I invest a little bit? He said, okay, we'll let you know. Then I read a TechCrest announcement saying that I'm an investor. So I called him up. I'm like, hey, I thought you were going to let me invest in you, but you just announced it. I don't even know the terms. And then he told me the terms. I'm like, wow, that's really expensive. Maybe I'll do a little bit less.
How much did you put in?
Put in 100K.
You put 100K in at the A round,
Yeah.
which I know was $100 million.
No, I wish.
A couple $100 million.
Whatever, it's not that much.
Anyway, the company's worth $8-10 billion right now.
Yeah.
So suffice it to say that is a 50x return.
It's like a 500x.
500.
200x, something like that. Yeah.
Wow.
And then I basically ended up folding it into a fund that I raised. So there's all
And then
kinds
you
of
blew all those returns since building out AngelList.
Spent it all.
And you
Wasted
made-
it all, squandered.
And just to be clear, you're making $0.0 on AngelList today. There is
Correct.
not one penny of revenue. There is not a revenue stream.
Correct.
Nor has there been for 2
We
years.
have gotten scotch and t-shirts and chocolate, so we encourage those.
You know, Deval, you really should spend some time thinking about a revenue model.
I know you wouldn't fund me, right?
All right, Dave, take us to that amazing meeting. Where are we? What are you wearing?
Okay, so it's probably from among SlideShare, Mint, Wildfire, Twilio, SendGrid, maybe MakerBot. Of those six, so SlideShare, Mint, and Wildfire have all exited. Wildfire is probably the largest of those exits in terms of a multiple from when I invested out of
Okay.
FP funds.
So tell me, when did you meet them and what was it about the entrepreneur? Where were you? What was it about the entrepreneur that made you just say, I'm writing a check?
Alan and Victoria had already won a grant from FB Fund the year before I managed it.
The Facebook fund.
Yep. I turned it into an equity-based structure when I took that over. Heaton Shaw had introduced me, actually I think Cat Lee and some of the other folks at the Facebook Fund had also mentioned them. They seemed like great folks. I didn't know that they were going to be as fabulously successful as they ended up being. But they seemed to have some domain expertise, knew what they were doing, and had previously run a business successfully. And we were like, okay, let's go to town.
Jeff.
Sorry, the point I wanted to highlight there was Victoria and Alan have had fabulous success. They got acquired for $350 million by Google last year. They built a 300-person organization. All those people pretty much went with them to Google. They are amazing entrepreneurs. That was not obvious at all 3-4 years ago.
And so what do you take away from that as an angel investor